Hello, I'm John Kicklighter, Global Head of Content at StoneX, and I'm here to talk about the biggest market surprises for me in 2025. Now, there were quite a few surprising moves from specific assets. There were some unexpected headlines, and certainly a rise and fall of themes that I did not think was on my bingo card. But what ultimately surprised me the most was a diminishing impact from regular scheduled event risk over time, especially in the second half of the year. Now, what does that look like? Well, we did see around the April timeframe the Liberation Day surprise, which was the White House putting large reciprocal tariffs on most of its trade partners. That led to a sharp decline in risk-oriented assets and almost tipped the U.S. equity indices into a technical bear market. Having shaken out a lot of the complacency and discounting significantly overpriced risk assets, the subsequent climb thereafter proved to be much more consistent than what we had seen previously. And that would also come with a diminished reaction to meaningful event risk. So a great example of this is the non-farm payrolls, which had some meaningful surprises through the year and is historically, year in, year out, one of the most impactful events in the broader markets. And we would see its impact significantly decline through the year. We would also see a diminished impact from measures like CPI and inflation readings, which an important theme, especially as it goes back to the construct of will it impact monetary policy and growth. And I think it all culminated in the December FOMC rate decision, in which we had a rate cut, an outlook that would significantly diminish the possibility of further rate cuts, a White House that is distinctly against or arguing the case for more cuts into the future relative to the central bank, and it would also introduce QE. That's a lot. Bulls and bears could take something from that, but neither would ultimately do so. Now, there's reasons for why these events would not move the markets. Themes, prioritization shifts amongst the masses. We have a very powerful complacency component in the market, which is more of that long risk-on kind of perspective that tends to take over when everything is otherwise stable. But as we get higher and higher, the complacency grows more expensive. There's greater risk to simply buying in at very stretched prices. And it's going to be very difficult to continue to reflect an ongoing risk-on mentality with no recourse or no sensitivity to risk, and thereby event risk, without something to back it up, like we've seen post-QE or post-pandemic stimulus. Without that kind of complementary driver to keep things quiet, as the markets get higher, the risks go up from staying so complacent. Good luck trading in 2026.